Swiss central bankers are being forced to choose between negative interest rates and negative consumer prices by the increasingly negative direction for the global economy. On a monthly basis, Switzerland's CPI declined in November for the fourth straight month. Meanwhile, Switzerland is trying to work through a contraction in output and a small but noticeable rise in unemployment. And all of this should sound very familiar because what we're talking about is not really about Switzerland, it's about the entire world. But central bankers outside of Switzerland, however, they've grown increasingly cautious and increasingly noisy over what they see are possible inflationary pressures. And this is where the Swiss example really stands out. Now, it's true in Europe, at the ECB, and other places like Australia, where the Reserve Bank of Australia today announced it thinks it's done with rate cuts entirely. But as I pointed out early last year when the Pringles can was first popped open by the Swiss, remember, watch the Swiss economy, not what other central bankers elsewhere say. That's because currently the negative rates versus negative consumer price dynamic is more extreme and much clearer over in Switzerland. However, it remains visible enough that it's not hard to see and not hard to find once you get into the actual data and move away from central bank rhetoric and the financial media's inability to see past it all. The media is filled with stories about resurgent inflation when there's none to be had. Markets are very clear on this, as we'll see, whether the negative rates already in Switzerland, their yield curves, or other yield curves around the world, and so too the view from consumers. In fact, when you look at the actual data, whether it be in Switzerland or the United States, like we're going to do here, markets or macroeconomic statistics, it's down on consumer prices, down on interest rates, down on everything else. And while falling tariff inflation rates or the fact that tariff inflation isn't happening sounds like a good thing, the reason why, as we'll see in Switzerland, is not. Just like the Pringles can, popping into rate cuts are a reflection of deteriorating economic circumstances. No inflation, rising unemployment, questionable, likely contracting economy. Again, it sounds entirely too familiar because that describes the reality pretty much everywhere. However, the problem is central bankers. Everyone takes them at face value. So when they say the economy's in a good place, like Christine Lagarde in Europe, and it's much more threatened by inflation than anything else, the financial media runs wild with it. And social media, of course, lights up with especially dollar debasement theories, inflation, 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 none of which stands up to the slightest scrutiny. And again, this is where Switzerland really helps sort everything out. Not the Swiss National Bank, let's be clear, Switzerland. It's the very definition of a global bellwether. And early last year, while everyone was doing exactly the same thing, shouting about sticky inflation and higher for longer interest rates, the Swiss National Bank instead, they kicked off the current rate cutting Pringles that we're still in the thick of right now. And that was way back in March of 2024, back when Jay Powell was still using the word sticky quite frequently, referencing inflation along those terms, along with strong and resilient when speaking about labor market conditions. But now that we're firmly into the flat beverage, it kind of seems ridiculous, but that's what the Swiss were in fact warning about all the way back then. Global conditions were souring, and that inflection was easier to see and witness from the Swiss perspective, given its situation as a critical banking and money hub. When the world increasingly seeks that hub out for safety, it's not a good sign. So money goes pouring in, the franc rises, the Swiss economy feels the downside, the Swiss National Bank reacts as a global policy beacon that everyone just ignores or loses sight of in the unhelpful noise of Jay Powell's and Christine Lagarde's. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. Now, with that in mind, the Swiss just reported their 4th consecutive negative monthly CPI in November. All of it unexpected, of course, because, of course, Swiss National Bank President Martin Schlegel last year said they're going to cut rates aggressively, and that will allow them to avoid negative consumer prices altogether. And when they do avoid negative consumer prices altogether, we should be seeing consumer price rates accelerate gently and modestly in Goldilocks fashion in the second half of 2025. Now, the Swiss CPI had a negative run late last year and to start this year, and it was enough by May that the annual rate for the index turned negative, validating everything that we've been talking about across the rest of the world economy and the market from 2024 heading into 2025. But once the tariff uncertainty disappeared with trade deals hammered out in the second half of this year, the Swiss, like everyone else in mainstream economics, believed the world would be right back on the right foot again. Cautiously optimistic on growth, cautiously optimistic on potential. Therefore, consumer prices in Switzerland were expected to turn positive and then keep accelerating modestly until they got up around 0.7 and maybe even 1% next year. Again, Goldilocks Swiss style. But unsurprisingly, never happened. There was an initial upturn in prices starting in May and June, but by July, the CPI was putting up 0 for monthly changes before, as I said, the next 4 consecutive minuses now through all the way through November. And that has the annual rate right back at 0 as well. So even worse, the core consumer price rate in Switzerland has slid now too, meaning that the negative price pressures aren't just about food or imported stuff. At 0.4% year over year for the core, that's the lowest Switzerland has seen for that index since August of 2021. So no acceleration, no hint of tariff inflation, just more ominous warnings and negative consumer prices. With these unexpectedly dismal consumer price rates, the Swiss National Bank finds itself in a trap of its own making because, as I keep pointing out, rate cuts do not work. And here we have more solid proof. When the Swiss National Bank cut by 50 basis points last December, going from 1% to 0.5%, Schlegel told reporters, the media, the world, the markets, and everyone who would listen that their aggressive response by the central bank would make sure that Swiss consumer prices never turned negative in the first place. Then, of course, they did. All of which, despite the S&P going even further, all the way down to 0 back in June, the rate cuts did not work. Rate cuts are only ever a response to the weakness. Therefore, they become a signal that even some central bankers are finally starting to get it. However, in this case, being already at 0, the Swiss National Bank has said it's very reluctant to go to negative on policy rates because NERP, as it's known, is intentionally inflicting harm on the banking sector for no good reason other than central banks have little other option to pretend to be doing something. It's creating a liquidity penalty for the banking sector whose sole purpose is to try to force banks to take risks, the very risks that they don't want to take. Therefore, it only makes the situation worse because banks that are already wary and seeking safe haven in Switzerland, and then they're being penalized for doing just that by the Swiss National Bank, that's somehow supposed to be stimulating something? Yeah, it is as stupid as it sounds, but what else do you expect from economics? That's why it never works. I mean, the S&P kept its policy rates under 0 for 7 years in the 2010s. That's how great it was and how much it worked. It took 7 years. If you have to do something for 7 years, that's a very definition of fail. And the reason why? The silent depression, the global silent depression. The more depression economics hit the world economy, the more safety was sought in Switzerland, the longer the Swiss National Bank had to stay with its negative interest rate policy. And it all makes sense once you realize what is really, and I mean really happening here, and how it's basically the opposite from everything that you get told. So while the Swiss National Bank and Swiss central bankers don't want to go to negative interest rates, the markets are pretty sure they're going to end up there anyway. After all, the markets have been leading the Swiss National Bank just like markets around the rest of the world have been leading the rest of the world's central bankers. Remember back in late 2023 and even early 2024, S&B then under Thomas Jordan kept saying they didn't even want to start cutting rates. But then the global economy forced them to do it, and really the global marketplace that was increasingly seeking the safe haven. Swiss rates have been negative for much of this year, though they've been less negative over the past week or so. The 2-year is still modestly below zero as the bond market globally really undergoes its latest short-run fluctuation. And remember though, Swiss bonds, like all government bonds, are still trading in the shadow and in the aftermath, the very visible aftermath of the 2023 banking crisis. While no one else talks about this, other than to give Jay Powell the full credit, the bond markets absolutely know the difference. The fallout from the 2023 banking crisis is one of the key contributors to the forgot how to grow dynamic, which forced the Swifts to pop the Pringles can in the first place. And it's not just the negative CPIs officials over there are going to have to worry about. Switzerland is also seeing rising unemployment too. It isn't huge, and it never gets all that high over there to begin with, but the latest official unemployment rate, also for November, was 2.9%. Now, since it's not seasonally adjusted, you have to compare it to last November's 2.6%, meaning a 0.3 rise in the official unemployment rate over the past year, and yet more evidence that rate cuts don't work. They're only ever a reaction to that very weakness that's being picked up in both the CPI and the unemployment rate. So what the Swiss National Bank is really doing is trying to wait out this weakness. They're taking the view that the global economy will eventually get everything together, will get past tariff uncertainty and start remembering how to grow rather than remembering how to do deflation. So Schlegel is going to try to tolerate negative CPIs with the view that they're going to be, yes, transitory. However, if you remember, and I just said it, he already said that once this year, and not surprisingly, he was already wrong about it. So we're seeing payback in Switzerland like we are in a bunch of other places after the artificial high earlier in 2025. That's not a recovery. It's not tariff inflation. It's more flat beverage Swiss flavor. The truth is that central bankers would rather talk about and focus on inflation rather than almost anything else, certainly what we're talking about here with flat beverage. And the reasons are not maybe what you would think, certainly not what they cite in the mainstream. It's not really about the 1970s and fears over repeating the Great Inflation. I mean, that's what you hear. Mainstream sources claim central bankers are constantly fighting against inflation because of that experience in the 1970s. Nonsense. The Federal Reserve, for example, shifting gears a little bit, kept seeing inflation ghosts around every corner the entire decade of the 2010s, not because Ben Bernanke, Janet Yellen, and eventually Jay Powell thought it was Great Inflation 2.0, but because inflation in their minds equaled an economy that was hotter than it was the dead one the Silent Depression created. QE didn't work, but if it had, then they were seeking the success in rising inflation. That never came about the entire decade, so you already know what to think about the Fed's numerous QEs, and don't forget, zero interest rate policy experience. I mean, just think about it this way. Inflation risk, meaning what we're told is an economy closer to the verge of overheating, that just sounds a ton better than job losses and disinflation, if not worse, or deflation like we're seeing in Switzerland. The former makes it appear that central bankers have done too good of a job. They're too powerful. Whereas the latter, as I just went over in Switzerland's experience the past couple of years, shows they're largely irrelevant and at best reactive. As a central banker, of course they're going to pursue the inflation story. Not only is it preferable to their perspective, it's baked right into all their worthless econometrics as well. So we see something similar taking shape at the Federal Reserve, at least among the solid faction of Casey Jeff and his band. In fact, if the markets are right, when Jay Powell announces his rate cut tomorrow, he's likely to make it sound as hawkish as he possibly can. That appears to be the only way that he's going to be able to placate the band and Casey Jeff to push this rate cut through. But keep in mind, like the Swiss, this group among the FOMC, they're not really hawkish. Their argument instead revolves around 2 points. First, they point to consumer price measures like the PCE deflator. They say it continues to be elevated, therefore that must reflect ongoing inflation problems and dangers. As such, the Fed should be very careful about lowering interest rates because, as they believe, lower interest rates could add to those inflation pressures that must be evident in something like the PCE deflator or the CPI. But as I just showed you in Switzerland, interest rates don't work like that, and policy rates at central banks don't work at all. There is no restrictive rate, and even if there was, central bankers would have no idea where to find it. Besides, as we see with the CPI, The only ongoing inflation pressure is from the fake shelter index. Strip that thing away and the inflation narrative falls completely apart. In fact, it gets back down closer to where the markets are, as we'll see in just a second. So Casey Jeff's second point is all purely anecdotal. He and those others that are like him, including the Cleveland Fed's Beth Hammack, they say they keep hearing from companies how these companies would love to raise prices on consumers. And that part is probably true. They would absolutely love to jack up the price on everything. But that doesn't mean that they will or even that they can. In fact, we know the opposite is true. Businesses that do raise prices and those that have raised prices like Target, they instead see their volumes fall off, which is in the end highly disinflationary. Not only that, because they can't raise prices, these companies search for other ways to offset the rising costs, which means cutting costs elsewhere, primarily employees, fewer hours, fewer workers. And so what does a central bank do when that happens? They don't raise rates because tariff inflation isn't a realistic threat. Central bankers end up cutting rates once they realize what's already happening. But it does take some time for all of them to figure this out. Thus, we're likely to get the hawkish cut in December. And over in Switzerland, the Swiss National Bank is going to say, we're going to be on hold for some time while we think all of these things through and get more information and more data. However, as I pointed out before, most of the Fed is already at this point to begin with. It's just these pseudo-hawk chickens who are making the most mainstream noise who make it appear as though the entire Federal Reserve is shifting in that direction. I talked about the Beige Book before, especially the one for November. It was almost entirely devoid of inflation, exactly the opposite of what you're led to think. And at the same time, it was completely filled with references to layoffs, as in fears over them. Not that they're happening. The Beige Book didn't say it's 2008 all over again, but that the chances of big-time job cutting are a lot higher than tariff inflation, at least according to the Fed branches as well as their staffs. So the Fed's Beige Book actually aligns very closely with what markets are pricing, what consumers are saying, and what we're seeing out of Switzerland. Casey Jeff gets all the mainstream attention, but reality undercuts him at every single turn. So let's start with the marketplace. In the Treasury market, TIPS break-even rates, they have not budged one iota this entire time. You got to go all the way back to February for the last case when shorter run break-evens were even noticeably higher. And even then, they didn't get very high. At the same time, their longer run counterparts didn't go up at all. In other words, apart from that one short-lived case, ever since February, the Treasury market has been steadfast, viewing tariff inflation as no threat at all. Like the bull steepening yield curve, the market has said, in conjunction with the Beige Book view and what we're seeing in Switzerland, labor problems are not just the biggest threat, they're the biggest ongoing problem. TIPS break-even rates are specifically designed to measure consumer price expectations in the marketplace, and since they see absolutely minimal risk of accelerating or even sustained inflation, what are we really talking about here? Nothing is ever close to zero, but especially longer run break-evens, it's about as close to zero as you're going to get. And U.S. consumers, by the way, they largely believe the same thing. And that's according to the data from the Federal Reserve itself. The latest update that just came out yesterday from the Federal Reserve Bank of New York's survey of consumers shows that short-run price expectations have actually been declining, though not all that much because they were never high to begin with. Only a slight bump at their highest point back in April, but since then, right back down into the historical disinflationary range. And that's especially true when you look at the 3-year outlook, which has been just as steady as the TIPS market. Nothing there. For the Fed's latest November numbers, it's stuck right at 3%, which is just the long-run average, consistent with the disinflationary 2010s that confused the hell out of Bernanke, Yellen, and Powell, who kept looking for inflation that wasn't there, and had they listened to their own survey on consumers, they would have known the difference. So again, Casey Jeff and his band are all over the mainstream media talking up tariff inflation risk and even threatening to vote on it when it doesn't show up anywhere from the markets to consumers to, importantly, Switzerland. So whether the survey of consumers from the Fed or the Beige Book, the real threat here is employment. But that isn't as nice to talk about in public or to have the public talk about. A solid economy on the verge of more inflation, it may not be ideal, but it's far better of an outlook than admitting that the economy is flat beverage and getting flatter all the time. But that's what the market's seeing. That's what the markets are pricing. That's what consumers see. And that's how consumers are behaving. And not just here in the US, it's everywhere. Call it affordability, but it's really just jobs and incomes. It's also what we keep seeing coming up in places like Switzerland. Yes, a small landlocked country in the middle of Europe. Yet time and again, what happens there applies everywhere. A globalist signal and warning about the state of the global economy and how central bankers, for all their inflation sound and fury, will eventually be brought back in line and be brought back into the Pringles can, whether they want to or not. Another good example of this dynamic comes from Japan. Another place that's supposed to be breaking out inflationary is instead a complete mess, starting with their households. I went over all the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.